welcome to this module on engulfing bars. Here we will discuss what engulfing bars are, how we use them, and when we use them. An engulfing bar essentially reflects a reversal, preferably one at a technical level. It shows us that there is a huge shift in sentiment in any given period of time, whether you're trading the daily, the hourly, the 4-hourly, the weekly. It doesn't really matter what the time frame is, but the fact that it shows us the huge shift in sentiment tells us everything. And it does that for essentially taking out the high and the low of the previous bar, like so with the OHLC bars. You can see here we've got a bullish engulfing bar whereby the high and low of the previous bar has been breached, reflecting a false breakout on the bottom side of this bullish engulfing bar, and likewise also with the candlesticks as well. The preceding bar is a seller bar, and it's followed by a buyer bar, which has taken out the high and the low of this first seller bar, giving us a very bullish signal that there has been a false breakout to the downside and the bar has closed as a buyer bar. And it's after this buyer bar has closed is where we expect a long move to happen thereafter. Ideally, the close of the buyer bar which follows will be above the high of the previous bar, like we have here. This is called a naked close, by the way, and these are a very bullish sign to us. So this is what a bullish engulfing bar looks like on the OHLC and candlestick charts, but what about bearish engulfing bars? Well, you've probably guessed they look exactly the same, except the engulfing bar is a seller bar, like we have here on the OHLC chart. It's taken out the high and the low of the previous buyer bar, reflecting a false breakout to the upside with the close below the body of the previous bar. It's the same story with the candlesticks as well. You can see that characteristically the engulfing bar has taken out both the high and the low of the previous bar. We can get this on any time frame. However, the higher time frames are the more significant time frames for this price action to occur. So why do we use engulfing bars? Well, they signal to us a number of things. Not only do they give us a very good confirmation based on price action on its own, giving us a very predictable direction it's likely to follow in, depending on whether we get a bullish engulfing bar indicating a long or a bearish engulfing bar reflecting a short potential move. They give us a very good logical reason to trade them, and this hinges on the false breakout followed by a thrust in sentiment of buying if it's a bullish engulfing bar, and a thrust of selling sentiment if it's a bearish engulfing bar. Certainly they work better in the higher reward to risk moves. I.e., if we're looking for a trend reversal as opposed to a trend continuation. You'll quite often find that if we're looking to trade an engulfing bar in a trend continuation, the reward to risk will not stack up. However, if we're looking for a trend reversal, then we could have enough reward to risk to justify a trading decision. But you might be wondering, when do we actually trade these engulfing bars? We only want to be worried about them at technical levels, key technical levels, like support and resistance levels. The harder, the better. And when I say a hard level of support and resistance, I mean one which hasn't been broken in a long time. The longer, the stronger. You've probably heard that expression before. So here's an example. We've got Euro CAD, and we are at the top of the range here, a 2-year high, and we have hesitation at this key level of resistance. We've got the engulfing bar, which has taken out the high and the low of the previous 2 days, which qualifies it as an engulfing bar. For your information, if the engulfing bar in question takes out the high and low of the previous number of days, the more days it takes out the high and the low of, the better the engulfing bar. It doesn't just have to be one bar it has to take out the high and low of. It could be 3 for a 3-bar reversal. It could be 5. It could be 8. It could be 10. Suffice it to say, if the engulfing bar takes out the high and the low of the previous 5 days or hours, whatever time frame you're looking at, that's going to be stronger in terms of a trend reversal than if it just takes out the previous one bar's high and low. So let's see how EuroCAD did, our trade based on an engulfing bar. It's a reason these key technical levels are absolutely fantastic when it comes to trading price action off the back of. They provide us with key zones, in this case a key zone of supply. And this was a very lucrative trade, remember it clearly. Of course, we took profit at this horizontal level right here. I'll just show you the level here. You can see this level looks very unlikely to be broken, and the hesitation we had at this level with the first pin bar reversal, followed by the inside bar, followed by the engulfing bar, was significant. So that was a bearish engulfing bar in a range-bound market. Let's have a look at bullish engulfing bars. The opposite, really. We just look for a key level of support, hard or soft, where we see a buyer bar having taken out the high and the low of the previous bar on that level. In the case of pound New Zealand here, we have this at the 1900 level, which is a round number. It's taken out the high and the low of the previous bar. Let's see how we did. Supposing we were looking to trade this long. There is frankly no reason to trade it short. So as you can see, the 1900 level spans back well over a year. It's a soft level. We also have in this instance a Fibonacci extension. If we take the Fibonacci extension from this point to here, we can see that the zone correlates with the 1.618 Fibonacci extension. So we've got what we call a confluence of reasons to go long here. Big number, Fibonacci extension, and our price action signal, in this case, the engulfing bar, also known as an outside bar, by the way. So we placed our order above the high with our stop loss below the low and targeted, for example, just below this previous swing high. Let's see how we did. Yep, hit profit, took the trade off, and didn't stay in for any longer. We went for a high probability, lower reward trade because this target up here seemed a little bit more likely in advance of this big round number than targeting further up the range. So that was a bullish engulfing bar. Whilst we'll see engulfing bars in both trending markets and range-bound markets, we find that the ones present in range-bound markets serve us a lot better because the reward to risk is a lot better. Even if it's a simple case of selling the top of the range and buying the bottom. If it's a well-defined range like we had with EuroCAD, we can simply say, yes, it's very likely it's going to bounce off it, but whereas our price action setup, if it's not a pin bar or a doji or an inside bar or a double inside bar, if it is an engulfing bar, then that's our signal to go long or short. And of course, if we're looking at range-bound markets as being our foremost choice, or foremost market of choice, the more factors we have on our side supporting our trading decision, as with any trade idea, the better. And of course, this always hawks back to level of support and resistance, trend lines, moving averages, Fibonacci levels, monthly, weekly pivots, and last but not least, big numbers.